I hope you guys can see the screen share okay. And now, since 2016, I and my colleagues at Republic have been working on solving one challenge: how to make private equity and venture capital more accessible, more available to everyone, everywhere. And you guessed it, that future of private investing is and will be possible only because of blockchain. The 1 second, apologies. I'm just gonna spend half a minute on a little bit of a background introduction on myself, because at the end of the day, why one does something, I think, is as important as how one does it. So I'm an immigrant from Vietnam. We moved to the Bay Area. We grew up in Silicon Valley, but never had any opportunity to invest, early. Not in Google, not in Amazon, not in Priceline. We weren't millionaires. We weren't accredited. So I went on to become a lawyer, worked in Wall Street, and again, the world of finance that dictate and grew the global economy, pretty much a playground for a very, very lucky and privileged few. So I went back to academia in Palo Alto at Stanford, and after that joined AngelList as its general counsel. I got into crypto and specifically bought my first Bitcoin prior to the interview with Naval Ravikant, because I knew Naval was deep in blockchain, and only then that I began to spend a lot of time looking into it. Now, the early phase of my time as general counsel at AngelList focused on the regulatory component rather than the technical component. And I'm going to clarify that a little bit later on, but not until 2017, that's when we expanded and incorporate blockchain technology into what we do in the mission to democratize investing. So the question should be why private investing in venture capital matters. Well, the sheer size of it all, $6.5 trillion in global private markets. That's more than twice, almost 3 times the size of the public market combined. It permeates from the small restaurants, down the street all the way to Airbnb and Palantir of the world. But when people think of private equity and venture capital, they think of big monies and funds and banks. People don't realize that it's a tremendous force of good. In the past 30 years, since the late 90s, 1.3 billion people have been lifted out of abject poverty, not because of policies, not because of donation, it's because of companies, entrepreneurship, private backed companies creating hundreds of millions of jobs, putting food on the table, and creating the biggest wealth generation event we have ever seen. Out of this entire world and the impact that it has created, because very few people were able to invest early, only a few people have been able to monetize and benefit from this generation event, the wealth generation event. Let's take a very quick look at the landscape as to how private capital has been deployed. Did you know that 50% of venture capital have gone to companies just in California? 50% have gone to back mainly social app. And Black female entrepreneurs responsible for $50 billion in revenue have gotten statistically zero backing. So it's very clear that in this world where talents are truly everywhere, but opportunities absolutely are not. So it takes us back to the question as to why is private equity and venture capital has been so limited in its reach and in how many people could participate into it. There are 3 main inefficiencies relating to this whole issue. I call it 3 systemic inefficiencies: regulatory, logistic, and technological, all 3 of which have been and will be made vastly more efficient with distributed ledger technology. Let's take regulatory inefficiency first. There's a non-blockchain component, and then there is a blockchain component. The non-blockchain component is this. Since the 1930s in the United States, the law was such that you gotta be a millionaire to invest privately. This falls under this whole regime called securities regulation. You see the same thing in most other countries. So in the US, up until very recently, as I mentioned before 2016, you gotta be a millionaire to invest privately, whether in a digital security or in a private stock. But since then, beginning in 2016, new laws have come into place, and it's clumsy, it's a little janky, but the framework works, and we've been able to make it easier and easier so that nowadays, whether it's a token project or a private company selling shares, everyone everywhere literally can participate. You got to jump through a few hoops, but anyone definitely can participate. The second and third complexities or inefficiency within private investings would be on logistical and technical complexities. So this spider graph here identifies what traditionally one would need to do, or a lot of people would need to do to facilitate private investing. You gotta check to make sure who the investor and the seller are. You gotta check to make sure that there's, identities verified and accreditation status also can be verified. The process on tracking, documenting, and effectuating the transfer of securities, private securities, also involve numerous parties. So all of these components over time slowly are being transformed by blockchain. Everyone knows that KYC, AML, and record keeping, as two examples, are things that have already been made vastly more efficient through various application of this new technology. The combination and the enablement of simpler logistical and technical private investing enable people like Republic to do things now that in the past was not possible. So here's one example. Recently, just this past summer, we fractionalized our future profit and revenue, break it into 800 million small components, and then sold them. And in the first wave of it was with the participation of over 12,000 investors, right? So this concept and the ability to enable so many people to participate was not possible before. You may be asking, so all of this is a little bit of old news, right? The ability to fractionalize, the ability to simplify and automate KYC, AML, accreditation, recording. What's different this time around? There was this whole promise in 2018 and 2019 that we're gonna see this renaissance or this emergence of STO, of digital securities. That hasn't happened. Why is now different? Two answers. In order to bring forth really the next phase of private investing, retail, global, and fractional, we need liquidity and we need adoption. And I'm going to dive in on two aspects in turn. So when it comes to liquidity, what do I mean by it? After you sell in the primary phase, for example, Republic is issued its token or digital securities from our end. How do we enable people to buy, sell, and trade these digital securities with ease? Because unless people can do that, why else would a lot more people get into the space? And the second question is that unless you reach a core threshold of adoption, there wouldn't be true liquidity. So it's a little bit of a chicken and an egg, challenge, but it's very much feasible today. And DeFi, the rise of DeFi in the past 2 years, bode very well for the future of both liquidity and adoption. And what do I mean by it? In the old world, in order to do private investing at the primary level and then at the secondary level, you have to deal with a lot of intermediaries. But one highly regulated component is the custody of the securities. There's a huge body of law, and you see NASDAQ and FINRA and the SEC and their counterparts in other countries exist to regulate this whole framework, because if an intermediary party entity hold on to securities, they got to be regulated. So the ability for custodyless, meaning direct peer-to-peer transfer after they agree on a trade, let's say the Republic note, the ability for the seller and the buyer to transfer directly without going through a middle exchange would make the regulatory framework a lot easier to navigate, not just in the US, but outside of the United States as well. So that notion, just in and by itself, would already expedite, in my opinion, secondary trading in the next 12 months, more so than we would have seen in the last 3 or 4 years. The second component of that is the user interface. You know, we all assume that everyone knows what consensus protocol or nodes or private wallet mean, but in reality, 99% of the world have no idea. How do you create an interface so that people can participate, even if he or she is 75, retired dentist, living somewhere in Alaska, still are able to participate as easily as sending an email? That framework, that whole UX framework, I think the industry has been lacking, and that happens to be something that we have also been working on. So the future of adoption hinges on that UX. We want to make sure that at one point, when people invest, it's like one click. It's like buying a thing on Amazon, and Amazon was known for this one-click purchase. We want to move, and I think that in the next 12 to 24 months, the industry is moving toward a place whereby anyone, anywhere can, through a click or maybe two, be able to invest privately. The underneath distributed ledger technology that had made the infrastructure more efficient, users don't need to know. They should be able to just log onto an app, buy and trade directly without going through a centralized exchange. At least that's the vision for it. So there's no question that private investing is beginning to go mainstream. And the activities, the different activities, the limited activities up until date, you know, it almost render pretty much every protocol to be more or less the same, but it really is not so, for this one reason. Today, 36 million people in the United States own some form of crypto, and only about 2 or 3 million people have purchased private securities, literally 1%. At the present rate, Ethereum and whatever other protocols seem adequately functional, but if you 10x or 100x the trading volume and the number of participants, scalability all of a sudden becomes a major issue. The Ethereum blockchain, upon which obviously the first wave of DeFi products are based, is not very scalable at all. This is because for a proof of work blockchain, every node must process every transaction. And because of that, throughput for Ethereum is at, I think, 15 transactions per second. But newer blockchains can scale to millions, right? Avalanche is an example. The novel consensus mechanism is a fusion of directed eclairograph structure and repeated subsample voting, resulting in latency at 1.35 seconds. That's what the Avalanche team told me, can process up to 3,400 transactions per second. This kind of advancement in cryptography technology, matching the pace of adoption, gives me strong confidence that in the very near future, you're going to see mainstream adoption of private investing. Let me go back to my screen 1 second here. So today, people already can invest in things like companies like Carter, tech companies. They can invest in game development financing. They can invest in real estate. But the future of the world, the one that I think everyone looks forward to, is that any asset can be tokenized. It may be a piece of art. It may be certainly real estate, movies, music. Tokenize and enable the early customer, those who believe in the innovation, in that it can become a very productive job generating industry, to invest early, trade early, and be a very core part of that, of building that very ecosystem. Why am I so sure that mainstream adoption of private investing powered by digital distributed ledger technology is basically here within the next few years? This is the map of adoption of new technology in the United States. And you go back to the early century of the last century, you have decades. It took decades for telephone and electricity and cars to gain adoption. And fast forward in the most recent decade, from 2010, things like social media and smartphone took about 3, 4, or 5 years. I'm highly, highly confident that in the next 2 or 3 years, you are going to see DeFi and private investing become truly, truly mainstream. So aside from, imagine a world that everyone, doesn't matter if you're a middle class or a single mom in Ecuador or Vietnam, can invest $5 and $10 into new startups in Silicon Valley, in Beijing, in Kuwait. Imagine that new world, the wealth that can generate, and how much more prosperous everyone would be. Did you know that 75% of Fortune 500 companies in 10 years are estimated to not have existed as of today? So in 2030, of the Fortune 500 companies, 350 of them are still in someone's heads, in someone's garage, around the world. If everyone can participate, and not only that they're going to be able to rise in that wave of wealth generation, they are going to play a key role in deciding the new technologies, the companies, and the future economy that we will be living in. But again, nothing is worth doing unless it actually means something. If in the past 35 years, 1.3 billion people have been lifted out of abject poverty due to entrepreneurship and innovation, and private investing and private equity financed only by funds and the wealthiest of the wealthiest. I strongly believe that in this coming decade, if everyone can and will participate in private investing, retail, global, fractionalized, only enabled by blockchain, then we're going to eradicate abject poverty once and for all. And with that, I think that everyone working in this industry, in the space that we're all living in, have a very compelling reason to be excited and continue to be excited about the future of not only the industry, the technology, but the world altogether.